everyone, and thank you for tuning in to another episode of FM Station by Mera Asset Mutual Fund. Markets have been showing resilience and strength since the last 7 months or so. While market euphoria is notable, there are also certain risks involved. 2024 happens to be an year of election in India and across the globe. Historically, it's been observed that volatility usually increases as rundown to election narrows. It is natural to pause and ask that which mutual fund category could one look at during such times. Well, one category which we could think of is equity savings fund. To know more on the same, today we have with us Mr. Harshad Borawake, Head of Research and Fund Manager at Mera Asset Mutual Fund. Mr. Harshad has an overall experience of over 18 years across industries. In his current role, he manages Mera Asset Equity Savings Fund, Mera Asset Aggressive Hybrid Fund, Mera Asset Balanced Advantage Fund and Mera Asset Multi-Asset Allocation Fund. Welcome Harshad. So the first and foremost question being, can you throw some light on the equity savings fund category?
Sure. So equity savings fund or the category is essentially part of a hybrid fund, hybrid category which has been categorized as per the SEBI. Within equity savings fund, essentially you have 3 asset classes. One is equity, second is arbitrage and third is debt. The category tries to take advantage of equity, which basically over the long term we believe give a better risk adjusted return. Second, there is stability which can be taken from debt allocation and also from the arbitrage allocation. So if you were to look at, let's say 2023, the calendar year, equity as asset class gave return of upwards of 25%, arbitrage and debt both on an average gave returns of around 7 to 8%. So equity savings category does nothing but to marry all these 3 assets into one fund. So typically, if you look at our equity asset class, equity savings fund, we typically have 1/3 allocation to each. So let's say equity can be between 40% plus or minus 5%. Arbitrage, because this has the equity taxation, so we need to have at least 65% equity plus arbitrage. So if you have 40% pure equity, then 65 minus 40, which is 25, that will be the arbitrage position, and the rest 35 will be debt position. So in a nutshell, I think equity savings is nothing but a combination of these 3 asset classes.
So post-debt taxation changes in March 2023, this category, equity savings fund category, saw an AUM growth of around 77%. So what according to you is the unique value proposition of the category which is making it so popular among investors?
Sure. Yeah, I think clearly, as you said, the change in taxation, so from April 1, 2024, the debt funds essentially now will be taxed at a marginal tax rate, so they don't no more have a indexation benefit. But if you look at equity savings on the other hand, while I do believe that it is not a direct replacement for debt fund, but nevertheless it is closer to, I would say, debt, primarily because the equity allocation in the equity savings fund is much lesser. It can range between 20 to 40%. So here I think somebody who wants an alternative for a debt fund, they can essentially look at equity savings. You see, you have 35% debt, which is a large portion, then you have arbitrage depending on the net cash equity, how much you have. So maybe 40 to 45% of the total fund could be mimic debt kind of portfolio, and the remaining will be the equity. So to that extent, I think one, this gives you participation in the equity. Second, it gives you a downside protection given that you have a debt instrument, and thirdly, I think from the taxation, I believe it's a superior taxation. So to that extent, as you said rightly, there was bound to inflow which could happen to the equity savings fund after the taxation change, and which has happened.
So you talked about net equity allocation levels. So Mera Asset Equity Savings Fund has historically, on a long-term average basis, maintained a net equity allocation between somewhere 35% to 42%. So what factors are considered during maintaining this net equity allocation range or a particular level?
Sure. So return of a equity savings fund will essentially driven by 3 factors. two factors I would say. One is how much you allocate to the each asset class, and second what you buy within the each asset class. So coming to your question, how do we decide how much to allocate towards the net equity? So we have our internal framework to determine what percentage equity should be. So that internal framework includes fundamental factors, relative valuation factors. From the fundamental point of view, we do look at earnings growth. Then if there is a sector like utilities which are balance sheet driven, so we do look at the balance sheet. And thirdly, we look at the valuation. And when it comes to valuation, it is not the current valuation but relative to history. So if markets go higher or if the valuations go higher, we cut down the equity, and vice versa, if the valuations are lower, we increase the equity. So that essentially determines what my percentage equity could be. So right now, if you see last few months, as you said initially, markets are doing well. So to that extent, we have cut down equity percentage by 1 or 2%. But net to, I think the point is there is an underlying framework which determines the net equity allocation.
So while we talked about the net equity allocation range, to further quiz you on the same, the equity portion within the fund, how is it managed? Do you manage it dynamically, or you tend to keep it static until a certain view sort of plays out?
No, I think the equity portion of equity savings fund is managed as dynamically as any other pure equity fund, I would say. So there essentially we look at 2-3 things. One is any company which comes in the equity in the fund, it essentially comes on its own merit. So what we look at 3 factors. One, we look at business, second is management, and third is valuation. On the business front, what we look at, how is the profitability, how are the return ratios. So for example, ROE should be at least 12% post-tax or 15% pre-tax. Management quality, while it is subjective, but we do look at how the balance sheet is vis-a-vis the peers in that sector. Coming to valuation, while it is good to talk relative, PE, price to book, but to the extent possible, we focus on DCF or discounted cash flow based methodology. So based on that, if the value which we determine is more than the underlying price, then the stock can be part of a portfolio. And coming to portfolio construction, there typically we have core and a tactical approach. So let's say 80-85% of my fund will be core, will be buying a security from a 3 to 5 year perspective, and the last 10 to 15% is tactical. So tactical is essentially either let's say stock prices move upwards by 5% up or down without any fundamental reason, then we might make some weight adjustments, or if there are some short term opportunities, we try to capture through this tactical approach. So yes, it's a diversified portfolio. Given the investor profile, it will be large cap bias portfolio, but I think it will dynamically manage similar to any other equity fund.
So you in the starting, mentioned, beautifully actually explained that, an equity savings fund marries equity, debt and arbitrage portion, or 3 of them together. So an investor coming into the same, in the current market scenario, how they should be looking or approaching the fund, say in the next 2 to 3 years, post the volatility that, we are looking at, we are assuming that, it could simmer down a bit.
I think, times are quite interesting, but mind you, if you have to look at last 10-15 years history, every time there is some event which is happening, either it's a positive or negative. So currently as we speak, clearly almost 60-65% of the global GDP is going through election, including India. So to that extent, from the news flow point of view, this year could be quite volatile as we have seen historically. Secondly, I think Indian markets have done quite well over the last few months or few quarters. Within that, I think large cap and mid cap has done much better. Mid cap and small cap has done much better than the large cap. So in this context, I think from the investor point of view, even I were the investor or you were the investor, I think the key question is, does it make sense to add more equity? What should be my asset allocation could be? So I think in that context, a hybrid fund or equity savings fund, may make a lot of sense. Primarily because while you might be afraid to go into equity, but here equity portion is quite lower vis-a-vis, I would say, pure equity fund, and then you have a portion of debt and arbitrage which gives you kind of safety or downward protection. Equity savings fund historically have shown good participation when the market moves, but at the same time, more importantly, when the markets fall, there is a decent, I would say, downward protection which these funds kind of provide. So I think in the current market context, it does make sense to allocate more if somebody is also have a issue whether should I go lump sum or through staggered manner. So while in the pure equity I might say you can go with staggered, but in hybrid funds I think you can go through a lump sum kind of way to invest on that side.
So any mutual fund should protect capital during market falls or the downturn in the market, and should also provide certain participation when the markets are going on the upside. And equity savings fund tends to do just that due to the mixture of the asset classes that it invests in, which being equity, debt and arbitrage. So thank you so much Harshad for your valuable insights.
Sure. Thank you.
Thank you viewers for joining us at Mirai Asset Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.